Welcome to Standard Chartered India Money Insights, a podcast series that brings you topical insights and local perspectives on India's markets from the experts.
Hello everyone, my name is Vinay Joseph. In continuation of our series on podcasts regarding our H2 outlook, gradually shifting preferences, today we discuss about our key investment themes. Before delving into that, a question we keep getting from our clients and investors is how should one incorporate thematic investing as part of one's investment strategy? Now, investors can use three approaches to thematic investing. Either your core investments with satellite thematic portfolios, or you can substitute some existing exposure with thematic exposure, or you can integrate thematics into one's core allocation. In our view, there's no single right approach towards thematic investing. However, whatever be an investor's approach, thematic investing benefits investors by capturing higher sources of growth. This is crucial because being right side on the growth as well as disruption is very critical for your long-term returns. Other benefits of thematic investments include potential for enhanced returns over a full business cycle, mitigating some of the traditional business dynamics, as well as mitigating downside risks over a multi-year time horizon. In our view, as equity returns moderate to a more sustainable pace and business cycles mature, thematic investing can offer investors a targeted approach. So at the start of 2022, we had enlisted three broad investment themes that we believed could help investors not only capture higher growth, but more importantly, mitigate some of the downside risks as the business cycle matures. Our first theme is broadening value rotation. Now, the performance of our broadening value rotation theme has been mixed YTD. Our call of being overweight public sector enterprises has outperformed, whereas our financials overweight call has marginally underperformed. In our view, we continue to see room for value outperformance to broaden further in the coming year. Now, value style equities benefits from a reflationary macro environment, which we are currently. We expect India's GDP growth and inflation to be above trend in the coming fiscal year. Faster rate hikes by the RBI and US Fed is likely to continue putting pressure on bond yields even in the second half, as growth remains steady and borrowing costs are still low. These are important catalysts and provide tailwinds to value sector, as they are historically positively correlated to rising growth and increasing yields. Also, fundamentals support value style equities, as value stocks trade at a 12-month forward PE of around 15x, cheaper to growth stocks PE of closer to 26x. Further, value stocks earnings revisions have outpaced growth stocks. Our second theme is India investment revival theme. Our preference for manufacturing and infrastructure to play this key theme has performed well so far in 2022. We continue to believe investors seeking to capitalize on this theme will be rewarded by taking a 3 to 5 year structural view. A pro-growth budget with the government's focus on boosting investments through greater public capex is a strong tailwind for the investment cycle. This follows government's earlier incentives to boost manufacturing and infrastructure. Overall, we believe key cyclical and structural drivers are in place to make this current investment cycle's breadth and size larger and sustainable compared to the previous power-driven capex cycle. Our third theme is positioning for higher interest rates. Now, these are for basically fixed income investors. Now, bond yields continue to rise in 2022. The 10-year benchmark yield is up over 84 bips to 7.3% YTD. A reflationary macro environment, higher inflation, and faster policy rate hikes is likely to keep pressure on bond yields. We expect the 10-year Indian government bond yield or IGB yield to trade closer to 7.75 and 8% over the next 6 to 12 months. In our view, a diversified bond allocation would be crucial for investors to tide through this environment of rising rates. We have made a few changes to this call since the start of the year. Given the surge in bond yields and widening yield premiums, we have closed our preference for corporate bonds over government bonds, given more attractive level for government bonds, and our preference for high-yield corporate bonds, as erstwhile inexpensive valuations relative to high-quality bonds which they had appear to have normalized. However, we retain our preference for short maturity bonds given lower price sensitivity to rising yields and a lot of the price higher interest rates being priced in, and selective bond strategies like target maturity strategies, dynamic bond strategies, and floating rate strategies. So that's all for today. Please reach out to your relationship manager for a copy of our report and keep watching out for this series of podcasts on our H2 Outlook. As always, if you like this podcast, please like and subscribe. Thank you.
Thank you for listening to Standard Chartered India Money Insights. Stay tuned for the latest updates and market trends by subscribing to our podcast. For more information, reach out to your Standard Chartered Relationship Manager or visit www.se.com/in.